Ever wonder what actually happens to your money after it hits your bank account? I mean, really happens to it. You earn it at your job, you check your balance on your phone, and it looks like it's just sitting there, right? Well, behind the screen, that cash does not just sit still. It gets loaned out to businesses to build skyscrapers, it flows into government bonds, it funds massive insurance companies, pension funds, and even the wildest tech startups on the planet.
Welcome to This Explainer. Today, we're going to look at the global economy, not just as a bunch of confusing numbers on a spreadsheet, but as a massive, living, interconnected machine. We are going to demystify exactly how this entire financial system operates, what the biggest institutions in the world actually do, and most importantly, how they directly impact your everyday life.
So here is our roadmap for today. We're starting with the macroeconomic puppet masters, the central banks. Then we'll zoom into the workhorses, which are commercial banks. Explore everyday investing, tackle the Wall Street heavyweights, and finally, wrap up with the risk spreaders.
Let's dive right into Section 1, Puppet Masters, Central Banks. These are the institutions setting the rules of the game and controlling the money supply.
To really understand how they influence your daily personal economic activity, we have to look at expansionary monetary policy. Let's say the economy is just moving way too slowly. The central bank steps in and essentially floods the system with money. How? By cutting interest rates. For everyday folks like us, it's kind of like putting the entire economy on sale. Suddenly, borrowing money is incredibly cheap. You can go out and get a car loan or a mortgage for a fraction of the usual cost, which, of course, totally encourages you to spend.
And the ripple effect of those policies is absolutely fascinating. Step 1, the central bank cuts rates. Step 2, borrowing gets cheaper for you and for businesses. Step 3, because loans are so cheap, businesses take out money to expand, which means they need to hire more workers and pay higher wages. And Step 4, with more money in people's pockets, spending surges, creating a booming economy. It's exactly why politicians are always pressuring central banks to cut rates, because a booming economy looks amazing on paper. But there is a catch. All this extra money and demand ultimately causes your grocery bill to skyrocket. That's inflation. And when prices get completely out of hand, the central banks have to slam on the brakes and do the exact opposite. Another massive lever they pull is called quantitative easing, or QE. Sounds super technical, right? But basically, when a central bank wants to stimulate a sluggish economy, they literally create money to buy government bonds from financial institutions. This pumps fresh cash directly into the system, keeping the gears greased and pushing all that money down to the consumer level.
Moving on to Section 2, the workhorses, commercial banks. They're the crucial dredge moving money from savers to borrowers.
Now, here is a reality check that honestly blows my mind a little bit. How do banks actually lend out money they don't have? The truth is, they aren't just lending out your exact deposits. When they issue a new loan, they literally create new money out of thin air. No joke. To understand how this is even possible, look at the reserve rate. Traditionally, this was a strict rule. If the rate was 10%, a bank with $10 million in the vault could legally generate $100 million in new loans. It was the safety net, right? Keeping at least some cash on hand.
But prepare to be shocked. Today, the reserve rate for most major economies is 0%. Yep, zero. Now, while they definitely still have other liquidity rules they have to follow, this ability to transform savings into brand new loans makes commercial banks the literal beating heart of modern finance.
All right, Section 3, everyday investing and pooled funds, which are basically just pulling together idle cash. A huge chunk of your paycheck is often whisked away here before you even see it.
Just think about this astronomical scale for a second. $60 trillion. That is the amount of money controlled by pension funds worldwide. Their whole job is to make sure retirees don't go broke, aiming for a steady 6 to 7% return every single year. But they don't just use basic savings accounts to get that. They buy massive global landmarks, like Hudson Yards in New York, and they pour huge amounts of money into hedge funds and venture capital. So while they might feel completely invisible to you right now, pension funds are quietly the largest single source of capital for high-risk investments on the planet. Then we have mutual funds, which are basically investment clubs for regular folks. They generally come in two distinct flavors. First, you have active mutual funds, where they hire finance professionals to try and outsmart the market. But because you're paying for those pros, you pay higher fees. Passive mutual funds, on the other hand, just copy an established index, like the S&P 500. Since they run on autopilot, the fees are incredibly cheap, which is exactly why everyday people often choose the passive route, to easily diversify their savings without needing to be millionaires. Next up, Section 4, the Wall Street Heavyweights. We're leaving the everyday investor behind now and entering the high-stakes playground of hedge funds, investment banks, and private equity.
So let's talk about hedge funds. Unlike those mutual funds we just mentioned, these are only open to accredited investors. That usually means you need a net worth of at least $1 million just to get through the door. They bet on everything. Currencies crashing, oil prices, crypto, you name it, they bet on it. And they charge a notorious fee structure known in the industry as 2 and 20. That is a 2% management fee on all the money they manage, plus a whopping 20% of all the profits they make. And the crazy irony of all this, despite these massive, massive fees, many hedge funds actually underperform the basic S&P 500. Then we have the investment banks. Think of places like Goldman Sachs. They are the ultimate matchmakers of Wall Street. First, they take private companies public through IPOs. Think back to when Morgan Stanley helped Facebook raise $16 billion in a single day. Second, they manage mergers and acquisitions, combing through the financials so a company doesn't accidentally buy a disguised dumpster fire. And third, they raise massive corporate capital by convincing investors to buy bonds.
Now, one of their absolute biggest clients is private equity. Think of these firms as the ruthless house flippers of the corporate world. Their favorite tool in the box is the leveraged buyout, or LBO. They buy a business using a mountain of borrowed money and then, legally mind you, dump that massive debt directly onto the acquired company's own balance sheet.
Let's actually trace how a classic private equity play builds over time. In year one, they buy a company, putting down maybe 20% in cash and borrowing the other 80%. By year two, they dump that debt right onto the company. They replace the management and they ruthlessly cut costs, like completely shutting down research and development. Because the goal here isn't long-term health, it's short-term profit. By year 5, they aim to flip the company for 3 to 5 times what they originally paid. And what if it all goes sideways? The private equity firm still wins. Take Tours R Us, for example. Private equity loaded the company with $5 billion of debt, forcing them to pay over $400 million in interest every single year until it finally went bankrupt in 2017. The private equity guys, they just collected their fees and moved right along.
Finally, we reach the last gears of the machine in Section 5, the risk spreaders. This includes insurance and venture capital.
Consider how insurance actually works within the broader economy for a second. You pay a mundane monthly car premium, and usually, thankfully, nothing happens to you. But the insurance company does not let that cash gather dust. They quietly recycle your payments straight into the global markets. They invest heavily in government bonds and real estate, so basically your safe driving subsidizes crash victims and simultaneously turns insurance companies into literal Wall Street titans.
And on the totally opposite end of that spectrum, we have venture capitalists. They are professional gamblers spraying millions at startups. Why do they do it? Because of the power law. They know going in that 90% of their startups will completely fail, and maybe 7% will just break even. But that tiny 3% sliver, those are the massive hits. In 2004, a $500,000 check to a random little startup called Facebook turned into over $1 billion. That is a more than 2,000x return. So one massive hit easily covers all the losers. So as we wrap up this explainer, I want you to remember that the financial machine isn't just some abstract concept reserved for Wall Street billionaires. From central banks pulling the macroeconomic strings, all the way to private equity flipping corporations, they all rely on one fundamental thing. Whether you realize it or not, every paycheck you earn, every car loan you take out, and every single insurance premium you pay is the actual fuel keeping this invisible global web alive. So the next time you check your bank balance on your phone, ask yourself, where is your money really going tonight?